With this week's kickoff of earnings season comes renewed focus on the stocks that have driven the market returns for much of the year. Those, of course, the biggest tech stocks, the so-called Magnificent Seven, Magnificent Eight. Joining us now for what he sees in technology is Dan Niles, founder and senior portfolio manager at the Satori Fund. Dan, good to see you. Thanks for joining us. Just checking the clock. Wish we had more time, but I thought interest rates rising, that these were the most vulnerable. And we know now maybe that multiple contraction might take a back seat to just chugging along and growing with earnings. That might be the key determinant of stock price growth.
Yeah, you're absolutely right. I mean, it comes down to stock prices are multiples times earnings. I think what's going to get tricky, though, is earnings season coming up, because if you look at the Magnificent Seven and you look at them compared to the overall stock market, you look at the Russell 2000, it's about 20% of their revenues comes from outside the U.S. For the S&P 500, that number is closer to 30%. The Magnificent Seven is 53%. And the reason that matters is the dollar has gone up about 6% since mid-July, which is when most of these companies guided. So that's a pretty big headwind to the fourth quarter guidance or looking into next year. And then on top of that, obviously, oil going up impacts some of them as well. So, that's, to your point, Joe, I think earnings, that's where actually a majority of this risk lies as you think about Q3 and, more importantly, guidance into Q4.
Well, you've been focused on some pretty good tech stocks, Dan. You've been able to beat the market in both up and down periods in recent years. So are you less bullish now on what got you to the dance?
Yeah, I mean, what we bought a few days ago was we bought a massive slug of stocks in the Russell 2000. Those stocks are flat year to date. We are long two of the Magnificent Seven, which is NVIDIA and Google. We like both of them. We think they can both do beat and raise quarters. We're short two of them, including Apple. And then the other three, we're most likely not going to be involved or more likely to be on the short side. So for us, we think that the market is going to go up between now and the end of the year, most likely. Obviously, the situation in Israel complicates this a lot, and we're managing the portfolio daily because of that. But I think looking at tech stocks, given the headwinds they have, you're asking for a lot between now and year end, because remember, the Magnificent Seven are up 96% on average year to date. The equal weighted S&P is flat. So I think it's going to be hard, especially with the valuations where they are for the overall market, which is above normal by, say, 10 to 15%. And for a lot of these names that are driving that overvaluation, to ask them to pull it much higher. And I think you're going to really have to pick stocks. You can't just buy a basket of all seven and expect them to work.
What's the other short, Dan? You said Apple. You're thinking about shorting three. You're short Apple, and then you're only long two. What's the other short?
It's Tesla, because we just think that with auto financing rates as high as they are, and with they've got a pretty high bar to clear going into Q4. At the same time, you've got consumer running out of money in terms of excess savings, and then you've got student loans restarting. We think there's a lot of headwinds in the stock. It's done great this year, and it's got pretty high valuation, and I don't like companies where numbers have got to go down.
Just remind me, what were the two you're long, and you're thinking about shorting the other three? What were the two that you're long? NVIDIA and
We're long Google and NVIDIA because we think those are the two we feel confident they're beat and raise quarters coming. But remember, even with NVIDIA, and this is a warning sign, right? They beat estimates by 21% for July, raised the next quarter, October, by 27%. The stock's down 4% from the day before they did that. So you're going to have to put up really good numbers if you're these other companies that don't have the growth that NVIDIA has, to be able to see these stocks work. And that's why we're in consumer staple stocks right now and Russell 2000 stocks. Those are what we're counting on more, which gives you a little bit of defense as well. And we saw that with Pepsi this morning, right? They're the fourth largest weighting in our consumer staples basket. I think you're going to see, that's what I want to be in between now and year end, especially with the geopolitical risk.